Hi, folks. So my name's Aneesh. I'm based here in London. I've been here for about 17 years. Most of my life has been sort of building tech startups. I don't know how I got addicted to this lifestyle, but it's addictive. It's painful, but it's fun. So I've had a chance to build three tech startups. I'm actually in the process of building my fourth one now, and ironically going through a fundraise. So some of the questions I'm sure I can tackle. I will confess, and I want to make sure that I also, kind of scale it back to where perhaps you guys are. Like, so if I think about my first, second startup, like the early parts of my journey, the challenges I faced were obviously much more relevant to what you guys are probably going through than now, where somebody the other day called me a seasoned entrepreneur. I don't know whether that was basically a word for calling me old. I have lost my hair building companies, so maybe that's the seasoned part of life. But I realize as you obviously go through the journeys, you fundraising kind of becomes easier. But I will try to sort of make sure that I address your questions. And we're all friends here. You guys are founders, so you're already my friends. So like, ask me whatever it is relevant. No holds barred. I think people probably know me for just saying it that it is. So like, if you have a specific question, ask me, and I'll try to give you the straight answer. So there's no sort of PR to speak here. But yeah, over to you, Purdy.
Do you want to run through what your prior businesses were and then any specifics around like fundraising and growth, just high level, and then we can get into a bit more detail?
Sure. So started off in 2007 when I was 23 with a startup that was very much a 23-year-old startup, which was trying to build a better browser on a smartphone, simply because we all had smartphones in 2007. How many of you actually remember your smartphone of 2007? I mean, it's a very different era, 2007. Like they were not the fancy bricks that we have now, but they were Kyocera, Symbian OS, very, very different phones. And we felt like, the internet on them is pretty bad. So if we build a better browser, we can have a better internet, therefore a better smartphone, a truly smartphone. So great idea. I was maybe too young, and I remember building it. The tech sort of started working, but then the 2008 crisis happened, and I remember like nobody, like we had meetings booked that people were canceling in terms of the fundraise because they were like, we don't want to know what's happening in the world. We don't want to touch startups, and especially if you kind of roll back then, there was just so much paranoia. So I remember that particular journey. Then that company didn't work out, obviously. The second company was a little bit more in the e-commerce space, ran that for about 6 years. Initially bootstrapped a lot because again, it started in '08, so there was just no funding available. So we learned the hard way about how to survive. And I think that's also kind of interesting. Like I've had that company, we did bootstrapping, government grants, corporate revenue-based funding, anything we could get our hands on to keep running. Eventually we got angel funding, and then we got PE funding, very unusual. We kind of skipped a level. And that company exited eventually. And then Air, which is the company most recently I built, sort of the last 9 years or so, much more of a fintech company, slightly more traditional in the sense, we did typical like angel round, then we did the seed round, then the Series A round, then the Series B round. We also managed to get strategic investors, so corporate venture capital firms, companies who are not necessarily pure VCs, and I'm happy to talk about that too, because I think it adds a lot of complexity and a lot of they dangle a lot of carrots, but you should really be aware of how to dance with CVCs, as they're called, because I think they're equally important in the ecosystem. And then now I'm building my fourth company. It's also a fintech, a little bit more on the insurance side. I've kind of skipped the angel round because we sort of funded it off the bank of Aneesh, as I call it, which obviously has limitations. But now we're raising a little bit of money to kind of scale up the company from where we are. So yeah, happy to talk about all sort of stuff around there, board, investors, the dance. I know the time we have won't cover everything, but later on, if you guys want to reach out, feel free to ping me. I'm sure Purdy can get you my addresses. I'm always happy to talk to founders. I think I've been very fortunate. Other founders have given me time and taught me stuff. And if I can do my 5 minutes to help you guys move the needle, I'm here for you.
Really appreciate that. For the founders in the room, if you do have any questions as we go through, or anything that Aneesh just mentioned that you particularly want to touch on, then feel free to put it in the chat and we can make sure the conversation goes that way, especially around CVCs, because we haven't actually spent a huge amount of time talking about them. We talk about the ecosystem and who some of the key players are and raising from angels versus raising from venture capital, but we haven't touched too much on corporate venture capital and like what that means and how the approach might be different or the conversations around it might be different. So maybe just a couple of minutes on that.
So should we talk CVCs then?
Yeah.
Okay. The short answer is actually try to avoid them as long as you can, and for good reason, right? I think a CVC's design is sort of what you need to understand, right? And maybe this is also general like knowledge. You know, when you're building a company, you should get to really understand the business model of everybody that you're working with. Like, I mean, I really spend a lot of time thinking about the vendors. What is their business model? How do they make money? How do their margins work? Obviously, the same way you should kind of think about a VC, like become really, really familiar with how a VC is set up, right? What does an LP mean? What does a GP mean? How do they get their money? Who do they get their money from? How much profit do they make based on X? How much profit do they make on Y, right? Like those areas you should be pretty familiar with. And it's important, and especially these days with, ChatGPT and all that, there's almost no excuse not to know these things. So the reason I say that is because you're going to be in business with them for a long time, right? There's this joke that you can't really fire your investors once you get them on. Ironically, they can fire you. So you should really, really get to know who they are, what they do, how their business model works, how their incentives are aligned. And so if you understood the VC part of it, the CVC, sort of the next stage up, is sort of, there's a bit of messiness that comes in with them, right? Usually they are a single LP. That's really what a true CVC is, which means that there's one real investor in them, which tends to be the corporate company. For example, I had Orange Telecom, the phone guys, their CVC invested in my company. And so a lot of 100% of their money at that stage came from Orange Telecom. And part of the remit was for Orange Telecom to think about what are interesting things we could be investing in that hopefully have a dotted line or maybe a solid line connection to the overall entity's journey. Now, since we're all friends here, I'll say it out loud. Like, despite what the CVC might say that we're independent, yada, yada, reality is if the money is coming from a certain company, there's going to be some conditions on that, which are you need to find investments which are aligned to the greater cause of what the company's building, right? If it's a telecom company or insurance company or this CVC in this case stands for corporate venture capital, the corporate assuming that it's coming off their balance sheet. There you go. No problem, Clive. Yeah, and feel free to put stuff in the chat. If I can see it, I'll try to answer right away. And it adds this level of slight complication where, because there is an additional requirement for them to think about what they're investing in, it may mean that you have to go through a couple extra hoops. And that's why I say early on, it is really taxing for the founders. So two things happen. One, a CVC's investment process is really long. Most of them are effectively attached to the enterprise. So if you think about an enterprise making a procurement decision, which I'm sure some of you are becoming familiar with, you know what that looks like. Think of an investment decision as like an extended version of that. There are committees and teams you have to talk to, and no matter how independent they are, they always have a relationship that they have to satisfy. So unlike a traditional VC where maybe there's 3 or 4 partners who kind of get together on a Monday, and usually one person has lead authority and they say, look, I want to invest in X company and I've done my diligence, and they kind of back them, and that's it. The decision-making process was in that 2 to 3 hour meeting. A CVC will have committees and committees and committees and process and paperwork. And it is possible you might end up delaying your round. And I've had this for me, I've had it for other friends who've told me the same story. To accommodate the CVC's process, which just runs way longer. And then because of the additional constraints they need, it might just create more chaos for you in the early days. Therefore, later on, kind of useful. They add credibility. They bring other, surprisingly, sometimes for a certain topic, it might bring you more revenue opportunities. So it becomes a game of chess that you have to manage really well. But early on, I typically say avoid them if you can.
Yeah, that makes sense. From a term sheets perspective, if they came in on a round, would you expect any difference in terms of what they're prepared to negotiate on with a term sheet?
So maybe another hidden rule amongst the CVCs is that they typically are not in a position to lead around. And actually, how many of you are familiar with this concept of leading around? I'm sure it's come up in conversations, right? I'll give you the most important, like, I know, Purdy, this was a different question, but I'll kind of weave it into this. Like, the number one thing a lot of founders go off the track on, and I've been there, is not focusing on investors early on who can lead. To the extent I am pretty bold these days, and I ask flat out, do you have the position to lead around? And that dictates how much time I spend with that investor. I'll tell you why. A lot of people are willing to follow. That's great. They're not going to get your round built. If you don't have a lead, the round never gets built, right? So a lot of people will tell me, oh, I have, like, 6 investors lined up, but nobody's leading. I was like, great, but you're basically at zero, right? Raising funding is like a binary outcome. Either you're 0 or you're 1. There's no probability that pays salaries. Remember that, right? If you're at 60% probability of a round, it doesn't mean 60% of your team's salary is getting paid. No, it only gets paid when 100%, i.e., all the money is in the account. The round is not closed till the money is in the account. Don't also forget that, right? You can sign papers and all that, diligence is happening. You're not off the hook. Till the money hits the account, you're not done. So you stay on their game for that. So going back, using this idea of the lead, one of the problems with CVCs tends to be they cannot lead. They usually are price followers. And it's interesting because the follower of a round has so much additional paperwork that even though the lead is kind of done, they're ready to wire the funds, the CVC is still kind of chugging along. They're like, oh, we're on step 6 of 9. I'm like, guys, like, this is ridiculous. Like, the other guys are ready to wire their money. You're still here. So sometimes you can do a dual close. I know you're going to talk to Anthony later. Like, he can explain about that. Again, complexity you don't want to be dealing with in the early days of funding. Maybe Series A, Series B, and all that, you can start doing like dual close, triple close. So yeah.
What do you think about ASAs then? And rather than having any lead, just getting everyone to sign an ASA or a seed fast if you're using seed vehicles?
I think it's fantastic that we have this. It's honestly something that a lot of UK founders were like, knocking on the door and asking for. So if I roll back even just 6, 7 years ago, it didn't really exist. I feel now pretty much all angel investments I'm doing are going through an ASA. I feel it's good. There are some, just like anything, it comes with some things you got to be cautious of. It's aligning us closer to the US model of early stage investing where people invest in a safe. And again, it's stuff that if you want to read up and get familiar with, I'm sure you can Google and read. The safe, or what previously used to be called a convertible, just a standard convertible, was really good as a way to get early stage money in. Now, the thing with the ASA is like there are a little bit of, because of the way HMRC structured it. Yeah, I guess you're going to talk to the right person after this. He's fantastic, by the way. There's like a 6-month clause or something that has to happen, and it does add a little bit of strain and stress on you as a founder about how you got to stage the game. The other thing I would say with the ASA is like it's okay for a certain amount of money, and you can probably do it with there's like a large collection of angels or super angels, but it's not okay when you're raising a proper like seed round or something sizable where you need sort of like an anchor investor, a lead investor. So just a little heads up on that.
Yeah, fair enough. You mentioned just then that you are angel investing as well, and I'm sure there's people wondering what your criteria is, or if there's any industry that you're specifically interested in, or anything like that. So just overview on your angel investments today, or what interests you, and then I'm going to start asking a few more questions about metrics and relationship building, both from your perspective as a founder and as an investor being approached.
So yeah, my angel investing is very small, but I do use it as a way to do 2 things. Like, one is naturally there's areas of thesis you come up with. Like, I'm like, oh, that's great. Somebody should build a company in XYZ area, right? I'm like, oh, cool. Nobody's building it here. And then somebody tells me, oh, there's, so-and-so company building in this area. They're kind of scratching at that problem. I'm like, great, because I believe in the thesis, because I've independently also come up with it. I see them building it. So I'm like, let me find that. And occasionally it's a little bit of serendipity, I'll be honest. It's not like I go hunting because I don't have the time for it. But I'll come across or somebody forward me, hey, look at this company. I have on occasion just emailed them out of the blue on their website. And I've had a couple people who have, fortunately taken my investment on that. And in some cases, I'm actually the first angel investor ever, which I feel always proud about. And I try to work hard for my investments. I will confess, like, the role of an angel is sort of like a transient role because you're kind of in there for the first few bits. And then as the company grows and sort of takes on institutional capital, the angels kind of lose their purpose. And in some cases, and I've done it for my companies, I've actually asked the VCs to buy out the angels, give a 4x, 5x return. The angels are happy, they take their money, they move off. The company's also rotated their cap table. Again, a concept you should maybe think about in fundraising a long time is like, if you're building a long-term company and you have a long-term journey, the angels are going to run out of patience, and some investors also. So you need to think about rotating your cap table so you're actually getting the right kind of investors for the right kind of company stage, a bigger topic. But so that's one. The other side of the interest in angel investing is often, and I guess maybe it comes out of like the areas I'm familiar with. So I've generally built companies in fintech / data algorithms. That's what I study. That's what I love. I'm like a math nerd, effectively. So like I see interesting plays and I'm like, oh, that's cool. I like that. I like what they're trying to go off. But I'll be honest, at the early stage, you're largely just investing in the individuals, right? The founders and sort of the initial building blocks that they have. And I often end up describing a company as I've invested into others as, look at this founder, this is what they're doing. And I feel like that's almost a narrative you also have to be able to build yourself into at that early angel investment stage, where the story they tell about you is kind of how you need to help them get to that story, right? Like there's a little bit of, this is like marketing. Like I never studied marketing, but eventually when I figured it out, I'm like, wow, the best companies in the world, like they tell you what they want to be, what they need to be talked about as. And that's kind of what fundraising is a little bit. Like you need to tell them, or you need to give them the pitch that they can go off with their other VC investors or other angel investors and chat them up. Hey, listen, what's a WhatsAppable message? Oh, I met Aneesh and he's building blah, 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 and it's doing blah, blah, blah. That you need to come up with almost for them. Because if you don't, what happens is they'll fill the space with something which is incorrect or mediocre, and then you're basically bundled in with something else, and that's what you were, right? So you almost are, your job is really there's a lot of marketing in the fundraising game, right? Let's face it. And there's a number of different avenues on which you're doing it. I can ramble on with this topic a little bit because it kind of leads into the other question you asked, Purdy, which is like setting up the thesis for it, right? Like so I look at this fundraising game as a little, especially the early stage of it, really, really early stage, as a bit of a flywheel you have to create. I'm a small investor, man. Like I'm like 25K checks. I'm already like, sweating bullets. But I am also a high conviction. So I don't do like 2,000, 3,000 kind of like spray and pray BS. Like I believe like if I like the company, I'm putting in a good check. I hope that answers. There's a couple more questions trickling and I'll try to take a look at them, but so going back to like the flywheel, right? This is really, I think, a big part of the way I talk about fundraising and the way I also tell other founders, and therefore I'll give you what I see it, and please feel free to talk to others. You'll get a collective of opinions. So I call this like there's a flywheel to create. Sorry, somebody's trying to Slack huddle me. Let me just get off of that one. Sorry, I'm back with you. My team is still working, right? So flywheel, one hand, think of this. And the other word, which you will get to love, is momentum. Right? Flywheel momentum, flywheel momentum. You need to be saying this every morning when you wake up and you're in the midst of a fundraise. You need to be saying this to your team. You need to be saying this to your co-founders. You need to be saying this to your partners, everybody. I'll tell you why this really matters. Flywheel. I'm going to talk about flywheel first. This is really like, this almost goes back to a very theoretical way of looking at it. And I do believe it's important as entrepreneurs to sort of appreciate this, right? Like, what is an entrepreneur? Like let's go back to like the very classic like economic approach to this, right? It's a person who brings together land, labor, capital, and creates an enterprise. I don't know if you guys remember this from like economics 101 or something, right? And I used to laugh at that, but I think it's a beautiful definition. I think it's Adam Smith or somebody who came up with it, I remember. But it really, really encapsulates what you guys are really in the midst of doing right now. You're taking a concept, okay, fair, it's not land, labor, capital in the traditional sense these days, but what it is, you know, labor equivalents, you know, like team and engineers and people. Land could represent like resources, you know, maybe it's the OpenAI tools or whatever else is out there, and capital, which is still capital. So land, labor, capital, right? The three of those things need to come together and start working in a flywheel. And I don't know if you're familiar with the concept of a flywheel. It's a really interesting mathematical idea. Like it just moves and it gains momentum. I'll come back to momentum in a bit. And your job as entrepreneurs really is to take these three interesting constituents that on their own will not come together, but you're going to show to the world that you're bringing these three things together and creating value out of nothing. That's why I also believe entrepreneurs are fantastic for the economy, because you create something from nothing. Three things that would have been standing on their own, looking at each other, but unless it was not the founder or the entrepreneur, value was not created. And you can look at any great company, that's how it started. Now, what is it that you're doing in there? Ironically, this is one of the mysteries of fundraising, but also entrepreneurship. And I think the best founders do this really well, where you're almost getting all three constituents to look at each other simultaneously and feel that sort of buzz and excitement. And I'll tell you, like great employees, obviously is where I start. I start with people first. I'm like, if I can great engineers, great co-founders, great people around me who are contributing to this problem that I've come up with, this thesis, then we have the first bit of that flywheel, because that's the one I can control, right? And nowadays, obviously, what you call land, labor, and capital, what land represents, i.e. resources, you have great tools out there, right? I cannot believe what OpenAI and all these guys are giving us for pennies. It's billion-dollar technology that they're giving it to us like almost for free. AWS, tons of dev tools out there, right? Again, I'm a little biased towards tech-driven software companies. That's what I've built. But you're getting these two sort of constituents moving, right? And I would say the third, capital, kind of needs to look at this and start saying, oh, look, this person's starting to get this flywheel going, right? Like they've got these two interesting constituents, they're moving it this way. Maybe I want to join this flywheel because this thing is going to go like spinning faster and faster, momentum, right? And then you're starting to sort of also use the other way around of it, because you also need to tell great employees, we're going to get great investors on board. We're going to have great capital. We can buy our own GPUs, whatever you're kind of building, we can do this. We're going to start small, but with the right investors. This is not like a mediocre small business. Remember, a startup is never a small business. I know many people think a startup is just a small business. A startup is like this company that's small because it needs to be at the start, but it's not its destination. Its destination is to be a large, game-changing company. To get stuck to be a small business as a startup is sort of a failure. It's a really unusual way of thinking about it. But that's what you're in the game of building. You're not building a small business. You're building something that leapfrogs a small business and goes straight to a large company that is generating millions in revenue and sort of, hiring tens of thousands of people, like Airbnb style or whatever. So land, labor, capital, that flywheel, you start getting it, and it creates momentum. And momentum is what is really important in fundraising, because momentum, and I want you to learn, like if you take one thing away from this call, just learn the word momentum, because it is so powerful in fundraising. It really unlocks everything. When people start seeing you're talking to investors, and investors also feel it in your room. If you've had like 5 or 6 meetings in a week, you're buzzing, your own energy levels are high, it carries forward into the meeting. And you will see in the meeting that investors will pick up like, oh, you know what? This guy or gal, they're talking to other people. They have investor momentum, right? Things are happening. They just secured another great data scientist. Something's going on. This company has momentum. And believe it or not, all investors talk to each other, as you would expect. All founders talk to each other. All people talk to each other. They all have their WhatsApp groups, even though they compete a little bit. They'll be like, oh, Jack just came to see me and, I love the pitch. They often will share pitches amongst themselves. So again, be very open and very transparent. Everything you say to everybody should be completely in sync, not story A to person A, story B to person B, right? It has to be in sync. And that idea then means like momentum starts happening. People will start pinging you, be like, hey, I heard you caught up with, Jonathan here about so and so. And that does start creating momentum, right? So momentum really is important. And underneath that, and I would say like this is just like your own personal management. This is really important as a founder. These 2, 3, 4, 5, 6 weeks or longer of fundraising that you're going to go through is going to be tough. It's really, really intense. Like think of this as like an all-out phase where you probably have to put a lot of things on hold personally. It's really tough, but a fundraise is its own journey. It is 7 days a week. You need to respond to emails quickly. You need to maybe tell your partners, your other half, even your kids that maybe for X weeks, I'll be a bit busy, and try to avoid having like a lot of personal commitments. It's just I'm saying this because you're friends, right? I want to tell you how it is. I don't want to sort of sugarcoat this. That period of X weeks that you're going to go through, just really be in the zone. It's like executing with intensity. You got to be ready for this slog. And it is important because the hard work you put in there will pay its dividends off because you will raise. Otherwise, if you kind of do a sort of kind of like no energy kind of raise, you will never raise. And you'll feel like 6 months later, you're still in fundraise. What the hell? Nothing happened, right? So again, few interesting thoughts in there, but flywheel momentum, really, really, really important. I'll stop rambling. Pretty, Margaret, tell me what else would be
Yeah,
unusual.
sure. But we'll move to Q&A with the founders in a little bit. I know we haven't covered like a huge amount of stuff that we kind of put down before, but I guess momentum, if we stick with that, momentum, if you're proving that you've got momentum, you might consider that traction or what someone might write on the traction slide, or if they send weekly, monthly updates to investors, like that's what you're talking about. Like, what have you achieved in the past month or couple of weeks? And how does that get investors on side? From your perspective, when you were fundraising and when you're speaking to people that are fundraising, like how did you demonstrate that you had that momentum? And kind of part two of the question is, how have other people demonstrated to you that they've got that momentum? Are there any standout case studies or something that you can share?
Yeah, it's a really good question, right? Momentum is different things to different companies. I'd say like if I kind of look at the best founders I have met, invested in, or just got to see from a distance, some of the things I've noticed that, look, storytelling is part of this, right? Like I'm sure you probably have appreciated that a founder's job is storytelling a lot. Talking is a big part of your role. So get very familiar with talking. You're going to be talking to investors, which is the easy one, I would say almost. You're talking to employees. That's an ongoing relationship daily and through thick and thin, especially the hard days. You're going to be talking to the media. You're going to be talking to regulators. You're going to be talking to customers. You're going to be talking, there's government. So you're going to be talking a lot, right? So get really familiar with storytelling and know how to like break things down in the ways you explain it. Some of the best founders do this really well. Find your own sort of voice or your sort of own natural way of doing it. It shouldn't come off like you're reading a script, right? Now, how do you evidence momentum, right? So I think there's a collection of things which are already happening in your business. Often this is the thing, you don't realize it. There's a bunch of things happening in your business already, but you aren't picking them up and converting them into a story soundbite. For example, you might have hired a fantastic engineer, right? And you probably went to battle to find this engineer, right? Like you went and you like, met with this person 6 times and you took them to dinner and, you got an intro and you're like, there is no way this amazing engineer joined my small little useless startup, but I've done that, right? And that's a great storyline because a great engineer can, move the needle on a certain thing you're trying to do. How are you talking about hiring of that engineer in your investor conversation? Is it like, oh, we just got in a CTO and they're just helping us write some code? or are you like bigging that up? And again, look, I am, there's a fine line between sort of embellishing the truth, and I don't think you should do that. You should always stay truthful because, like I said, be honest because things will get out, or just kind of correctly portraying the story of what you have accomplished. You got a big engineer over the line, or you got a contract over the line, you got a pilot over the line, you just started getting the first revenue. Talk to me about the first revenue. Show me what happened in the meeting. Oh, you know what? These guys were saying the procurement process is going to take 6 months, but they sent a couple emails and they pushed it. And in 3 weeks, we went from first meeting to actually money in our account revenue. What does that tell me? There's like something's happening in this company. They're great engineers. They managed to do this. They're getting that, right? Oh, look at this article that we were mentioned in, right? So there is like stuff that's happening in your company's sort of bubble. You just need to like pull it up. And there's maybe one of the things I do, and again, this is personal to me. I'll give it to you. I don't know whether this will work for you. This is, you know, how I tend to do it. Before I even do the slides or the deck or anything, if for like an upcoming fundraise, I like writing. I'm not a great writer, but I like written text. I actually write a 2 to 3 page like internal like document. Very boring technique, but it works for me, so I'll share it with you. Maybe it'll work for you. I hope it does. I write it out. No slides, no graphics, no fancy words, in plain English. You know, open a Google Doc or whatever, just write 2 to 3 pages in like one flow. Maybe it takes 30 minutes, 40 minutes, an hour of like where the company is, what you're doing, why you're doing it, what's happened. And you'll see like you kind of end up building a great, I call it the narrative, right? You kind of figure out what the company is about. Because if you start with slides, which I know is kind of the temptation is, oh, let me make a fancy slide. Oh, I saw my friend has a slide with this arrow going this way. I'm going to try to copy a slide like that. What happens is you're kind of backfilling your story into somebody else's narrative, and that doesn't work. So start with your narrative, build it, refine it, sharpen it. In fact, I am so strict with this. I don't even like leave the document till I'm very happy about that document. You know, the 2, 3 pager, if you may. And sometimes I'm on that for like many days because I'm like, that's not quite right. I need to do this. And I'm, you know, within reason, there's a couple people who can kind of look over it and give it a little bit of polish. Once you're there, then you start building your narrative. But what you've done is by collecting these thoughts, and over the couple weeks, you'll start off like also be like, oh, okay, yeah, we just did that. Or I can't forget, oh, we did that. You start adding up a little bit of a list of things, which go back to your idea of momentum, right? You're starting to build a little bit of like a running list of what's happened in the business recently in the company. And then you create the slides, and then you create your narrative. And you know what's also great is if you have a co-founder, and I'm assuming many of you do, it gets the two of you on the same page too, right? Obviously, you'll know one person is the one who's kind of running out there, cracking the whip in terms of fundraising. The other person sort of has to take a back seat just because it's more efficient to have one person out there while the other person looking after the company. But eventually, both need to be in the room, or all three of you will need to be in the room. So that also allows you to have like, hey guys, this is our like investor narrative. Everybody like read this, like be comfortable with it, right? So again, I mean, I do it. Again, you might have a different technique. If you have, please share. I'm always happy to learn. But that's something that's kind of worked well for me over the years, writing it and then doing sort of the stuff downstream from there.
We were just chatting to a angel investor last week who said that that's how he would prefer to receive information from founders as well. So he doesn't like looking through traditional decks. He would rather see continuous prose of someone's thinking about how they're building their business. So
Yeah.
as well as a useful exercise, it might actually be useful for investor conversations too.
Yeah, I'm not sure. Yeah, and it's interesting. Like there might be some investors who are like pro it. Some might still want the old school stuff, but the activity always helps. In fact, you're right. I have sent the written 2, 3 pager to a couple people occasionally, and that's helped.
Yeah, because we have people ask us about raising investment with the like, oh, should I have the problem, solution, opportunity, like these kind of like 10, 11 slides that everybody's expected in the order that everyone's expecting, or should I go rogue and try and, you know, tell the story in a different way because maybe that makes me stand out a bit or be more interesting? And there's loads of different opinions on this, but what's yours?
That's a good question. I mean, look, there is no standard format. Let's start with that. I think the same is true for life as well, or building a startup. There is no like standard format of like a book to follow. That said, there is one thing which I personally always think a startup should really have down pat. And I think this is, you know, forget the investors, just even for your own employees. like if you cannot articulate the problem you're solving well enough, then you're always sort of building the startup backwards, right? And I'll say this out loud again, like, I don't know if you've ever heard of this phrase. I think it's a YC phrase, like fall in love with the problem. It's such a fantastic idea. Like, I love that phrase, but if you cannot explain the problem properly in a concise way at the start, and especially for employees, I mean, really, really, really important for employees because they're going to be there at work every day, fighting it out, writing code, doing whatever. If they don't know the problem the company's looking to solve properly, they're off. They're going off on a tangent you don't know. So being able to say the problem is important. And I do kind of like to see that up front. I mean, maybe a bit old school in that, but I think having the problem up front is really, really important. How you follow from there is kind of like your own thing, but do fall in love with the problem and make the investor fall in love with the problem. I mean, it's 90% of your battle is done if they believe in the problem.
Yeah, because they know the solution is going to change.
To some extent, correct. Yeah.
Does anyone have any questions? Do you want to raise your hand if you have a specific question that you want to ask? We do have some in the chat. I've got some more that we can go through as well. So raise your hand if you want to ask a question directly. Whilst we're waiting on that, you mentioned a bit before about the rotating cap table. MA asked how you frame those conversations with angels. So if you're thinking about getting into a situation where you ask your VC to buy out the angels, how would you approach that?
So usually this probably only happens at like Series B, maybe at A occasionally, but B usually. And I think in a way it reflects the maturity of the founding team, the management team as well, right? Like, you're saying, hey, look, we're not here to just kind of do this quick little thing and kind of run away. We're building a large company. We believe in the next phase of the company. The company's maturing. We need to rotate a number of things. The cap table is actually the easiest thing to rotate. I will give you the scariest thing to rotate, and I've had to do this, and I've had to help my friends do this, is rotate your management team. And that includes co-founders, right? Scary thought. Like, oh my God. And maybe you're the co-founder that needs to get rotated. Also be willing to do that, right? Have the self-awareness to put your hand up and say, hold on, we started a company, we were like 5-6 people hacking away, writing some cool code. Now we're 60, 70, 100 people. We're regulated. We're operating in 6 countries. Is this happening, that happening? So much investor capital, so much media attention. This is not the kind of management job I need, but I'm happy to be a contributing shareholder. I'll step back, right? And maybe it's the conversation you need to have with other co-founders or other early employees who have become senior leaders. And in a way, like maybe that's the self-invention that you got to think about like every few years as a company. And part of that is cap table rotation as well. Because you'll be like, hey, now we've reached this stage. Now the company is going to be focused on this next phase of growth. And dear angel investors, we loved you for getting us here. We have a Series B deal happening. You're going to get a 6x markup. Obviously, I can't force you to sell. But the way I used to say this out loud to them is like, it's a 6x markup. You invested in me X time. It's been this many years. I would suggest that this is a pretty solid outcome. However, if you choose to roll in now, don't come back to me if things go sour from here, because a company can go down at any stage. Remember, this is the other thing. Maybe part of fundraising is like the only valuation that matters is the valuation at which you exit. People get so hung up on the valuation at which you raise. It's absolutely pointless. It's the only one that matters is the tail end valuation at which you exit. Everything else before that is like the stock market. Right? So do also keep that. And then maybe some of that is helpful for investors. Just, because of the UK SCIS rules, and I'm sure Anthony after this can tell you, certain things about timelines and all that before you can buy out an angel and they can get their thing and all that. Minor problem, but just keep an eye on that. But it is something I'd say you should not, execution, big part of execution is taking conscious decisions to choose the journey of your company. If you just keep going with the flow, you'll get a mediocre or average outcome. To be a great company, which is the only reason you're building a startup, because if you're just going to be an average company, you're going to be with the flock. You're trying to be an outlier. You're trying to be the next best thing. You kind of have to consciously choose decisions to go on a certain path. And some of that will be rotating teams. It might be hard, but you have to do it. Rotating angel investors, shutting down a certain office because you just realize that's not working out. It's emotionally hard. A small business would never do that. A startup will, right? So again, there's a slightly different playbook of a game of chess you play as a startup than a normal business.
Yeah, thank you. There's another question that's come in on the chat. What do you suggest for a founder who cannot get reliable data to calculate their TAM SAM sum?
I mean, it's like a wishy-washy answer, but do best efforts, like try your best. I mean, you can obviously throw Anthropic and GPT and all these guys at the job now, and you'll see how far you can get. I've built a company in a space once where it was hard to get numbers, and we had to just kind of explain this is management's estimate of what X looks like. You show them the working, and you let the investors go do their diligence on their own. But that's why maybe starting with the problem helps, because the problem really helps frame the space you're inside rather than the solution trying to fit into a space. So yeah, maybe that's a quick answer on that one.
Awesome, thank you. Anybody else got any questions? Because I've been talking a lot and there must be other stuff that people want to know.
Maybe
just
a
on
show
the
of hand,
CV.
like who's actively raising right at this moment? Okay. And have you talked about this to your partners, friends, or other halves and let them know that you're going through this? That's one more thing I'd say. Just, the personal toll of being a founder is not non-trivial. So do kind of like think about the ecosystem in which you exist personally as an individual, and talk to your team about it too, to some extent. Guys, like, the founder is going to be busy for the next X weeks. We're not going to be able to respond to Slack messages. I'm sorry. And, we love you guys. We care about the company, but just, bear with us. We're going to respond with like, emojis, maybe that's it. And, hopefully if this goes well, the outcome of it is that we can hire more people. And maybe we can buy the swag that we wanted, right? So maybe also add a little bit of a fun thing behind the fundraise. Like I used to always, like every fundraise, we did a small thing. Now it's not like you're wasting the money, but it's like a little bit of a little acknowledgement that, guys, we went through this phase. We've grown the company. We've hit an inflection point. This is the next thing we did. Go ahead. I think there's a couple hands. I think it's Austin and James.
They might be from when you were asking if they were raising.
Okay.
Yeah, but I do have a question, sorry. On the CVC piece, and we're just starting a process actually this week. We're starting a partnership with a massive fashion house. The question really was, I know the process is going to take a long time because they want to see a number of partnerships. They've got quite a big fund they can lead. But how have you got any ideas, thoughts on how we keep them engaged? Because I think it's going to be a 9 to 12 month relationship before we see the cash.
Yeah, and I think that's maybe also a precursor to the fundraise, right? Like a CVC usually is investing once they've kind of seen the strategic part of the business click together. And that means there's already a 6 to 9 month lead in you have to do. And so are they really an investor in this round or the next round? Right? And maybe that's the framing of the conversation. Maybe it's upfront. And I think the more mature you are as a founder and more conscious you are in the choices you make, you can tell them, guys, we love the dancing together we're doing. Let's focus on that. Let's make that excellent. And then, come 2025, we will look at investing because we might do a second round.
Yeah, I mean, we just raised the bridge on the basis that we know it's going to take a long time and there's going to be, like you say, quite a big dance. The expectation is, they're an incredible strategic partner for our business. And we're also very aware that the partnerships may not work and it may go cold. I was just thinking more in terms of, do you send them lots of updates? Is there anything that you've done with the CVC that you found worked really well?
Yeah, I mean, CVCs are a slightly different animal altogether than normal investors. Are they competitive to you at all, or
No,
collaborative?
they own. This is one of the things, they have a competitor that they own, but they're not operating in the UK. So I think
Okay.
they will do a
One of
lot
the things with
once
a
it's made.
CVC, and this is maybe more like also just generally a company. Like, remember what happens with a VC, a traditional. That's why, like what I was saying earlier, go learn how the VCs are built as a company and what they do. They're kind of like the guys are like chained to their desk because they're partners in a fund for like 10 years, right? And this VCs implode and partners don't get along and all that happens. But largely, they're going to be the same gang that's going to be there for now or 10 years, right? They're all like locked in. That's not true about a CVC because a CVC is largely the extension of a company. And what happens at a company? People are there for 2, 3 years, they move on, they get to different things, they zigzag through their careers. Same will happen as a CVC. So it is possible the guy who's like chatting up you now can leave and go off somewhere else, and all of a sudden your relationship breaks. Number one, that's a problem. So go wider, spend as much time meeting as many people inside the C, not just the CVC, right? Which is also good for your business.
Yeah.
Also, it's interesting, sometimes the CVC person that you're dealing with ends up at a fund. So that relationship has a double benefit because they could also then become a traditional investor. Sometimes this is happening now where, you know, Andreessen Horowitz and all those guys are constantly bringing in ex-CVCs because they have like sector depth in terms of like, oh, I've seen them do stuff in this space deep, 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 and give them a better operating structure. So again, yeah, always relationships helps, spend time. I actually am a big believer in IRL, so I know we're doing this on Zoom, which is convenient, but where possible, especially with investor stuff, try to find an excuse to see them in person.
Brilliant. Thanks.
Thanks. James, do you have a question, or was your hand raised from before?
No, thank you, Purdy. I do have a question. Aneesh, it's a real pleasure to meet you, and thank you for your insights so far. It's really interesting. We are a real world business. We're 4 years old. I bootstrapped it from the start. We do a 6-figure turnover. We're profitable, but we struggle to raise. We're in the art market, but we're transitioning into kind of Web3. So we decided to take a slightly different approach to raising and raise through a token launch. So we're building our ecosystem on Solana. We're into pre-sale of our token. And I think my question to you was very simple. Would you consider a non-equity investment?
And me as an individual, you mean?
Right. As you as an angel, what we're doing is we're essentially pre-selling our token to, I call them supporters because I don't necessarily want to call them investors. I want to build a community who are supporting us and working with us long term. So we're selling our token to pre-supporters before we launch on a Hong Kong exchange in June, and in return giving those supporters a 20% upside on the pre-sale. It's a slightly different approach to going out and selling cash for equity.
Yeah, I mean the challenge is like because I don't understand the underlying concept. I'll be honest, I've understood a lot of things in life, but tokens I've never understood. So like I'm like automatically like probably self-selecting myself out of possibly a pretty interesting thing. But maybe you know, think about why do angel invest, right? Angels invest because okay, some of them invest for monetary reasons, but largely if they just wanted to make money, there's better ways to make money than investing in super high risk startups, which have liquid equity for like tens of years. So that's not really it. Most angels invest, keeping aside the few who are looking for tax relief, for the curiosity or wanting to see a company being built in a certain area, right? And that's commonly obviously true for those who are like operators turned investors. So again, it's kind of comes down to like, if I don't get the equity and all that in there, then like, am I really participating in the ride? So yeah. Anyway, it's an interesting question, but yeah, probably that's me out of that conversation.
No worries. It's interesting because it's a new model for helping to raise capital, and I think a lot of people don't quite understand that modus operandi. Think of it as an IPO essentially, and you know what we're doing is we're building a community of supporters who are coming in early, but for the long term. So we build value in their holding, which hopefully gives them not only a return on that investment, but also gives them participation in the direction of and the future of the business through what's called a DAO, which is a decentralized autonomous organization. It's a community-driven business, essentially.
I'm just going to just move on because we've only got 5 minutes left.
Move on. Cool. Thank you.
I know you started asking a question before.
Yes. So basically, my question is, because I will go through the seed round anytime soon, probably throughout the summer. My question is, my fear is that the term sheet, it takes too long for investors to agree all together to the term sheet. So how I can manage this period of time where if I talk with one investor and they are ready to wire the money on the month 1, then I have, after, I don't know, 3 months, another investor that is ready to wire money, but not literally doing yet. And why I should give the same deal to the second one if they haven't yet wired the money.
So maybe the underlying question is like, and I think I talked about this earlier, like the lead. Without lead, the round is never built, and the lead sets the terms. That's the job of the lead. They get to set the terms. They get to kind of create the first part of the sculpture, and others are coming and taking a picture of the sculpture. That's the way you got to think about it. So all the others, and fair, there might be, you can do 2 closes, but you can agree to it up front, like, close 1 and the next close is 60 days later. I know there's a 60-day gap, but largely that's considered, non-significant. But the lead matters. Without the lead, the round doesn't get built. You're not negotiating multiple team sheets unless you're negotiating with multiple leads. That's a completely different process, and that's a competitive playbook. I will say that's like pro level stuff. And even good founders often don't want to take that headache of having a super competitive round. I mean, I have an angel investment. She got 8 term sheets. Fantastic, obviously. I'm really proud that, she's gone and done that. 8 term sheets to manage from 8 different lead investors, really playing them off, optimize for the company. Fantastic. Super stressful. So I think often people are like, if I get 1 or maybe 2, I think I'm happy and I can build my round and move on. So, yeah.
Okay, so I will focus on question.
The lead.
Sorry.
If you get the lead,
Yeah.
the round is built. It is
Yeah.
like, it can be unbelievable. You'll have people sitting on the fence being like, You get a lead, everybody gets off, they start emailing you. Magic happens when the lead shows up. Unbelievable. And unfortunately, in Europe, we do have a little bit of challenge. There's less leads than in the US. It's just something I've noticed, and I think data maybe shows that too. So get the lead, things will sort out themselves.
Is that because they do the due diligence?
Yeah, they do all the grunt work. They make the phone calls. They put their fund's name on the line and effectively saying, "I believe in this valuation. I believe in this company," and the others follow in.
Okay, brilliant. Thank you.
Go ahead, Purdy. I think we're almost out of time as well, actually. Oh, you're on mute.
Got 2 minutes if anybody does have any other questions. If not, I will end with some practical tips for engaging investors if you're coming in cold. Anything from you?
Yeah, I think this is a tricky one. I've really found cold as in you're just emailing them from their website.
You haven't ever met them before, so you might be
Oh.
dropping a LinkedIn message or an email.
That's just, I would say that's again, the hustle of being a founder and entrepreneur. Your job is to build relationships. Investors, again, easy. You're building employee relationships, customer relationships, government relationships, media relationships. You need to have your own persona, your own confidence, your own playbook to how you're going to talk to people. Again, like I said, a big part of being a founder is storytelling. You're at the front of the pack talking and yelling. So, be willing to do that, right? Like investors are, maybe they're former entrepreneurs, maybe they were operators, look up their companies, talk to them about what they did, right? So that is, I think, just generally good advice for all things. Like you have to just learn how to build cold relationships across the board, especially with investors. As things are maturing, and I'll just quickly use this, and you feel like maybe there's going to be a term sheet coming, and I know it's a different feel because you have to kind of like guess it out. Feel free to also just reach out to them and say, hey, look, I'm going to be in your area. Can we meet for a coffee? I just want to talk a little bit more about your fund or do a reference check on your other founders. All of that is great. More FaceTime, more alignment, especially with those who are going to be on your board or on your cap table. It just helps. So
appreciate that. Thank you so much. we're at time. We've got Anthony who's just joined the meeting room as well. So Aneesh, last quick question from me, which is that if anyone wants to reach out, email address, LinkedIn, what's the best way for them to do?
LinkedIn is also really fine. I use a LinkedIn inbox as almost like a second WhatsApp these days. It's perfectly fine. LinkedIn is great. But also, yeah, you can get my email from Purdy directly. It's my Gmail. Drop me a line. Yeah, happy to help as a founder. Happy to look at your pitch if that's of interest to you, or yeah.
Appreciate that. We'll post that in the chat, and then we will just stop recording and say goodbye for now. Thank you so much.
Awesome. All right. See ya.
Thanks. Yeah. Bye. Bye.
Good luck, guys.
Thanks so much, Aneesh. That was good.